Hey everyone, welcome to our first Inner Circle workshop of 2026. I'm Brad Gotto, CEO of Fiat Wealth Management. Here with me is Miss Carly Carlson, CEO of Fiat Tax,
Hi,
the
everyone.
actual brains of the operation. How
For
are you,
this
Carly?
conversation, maybe. Good morning.
You're taking an hour out of your day during the quintessential busy season for CPAs. So number one, I just want to say thanks for that. And I'm sure everybody that's listening in is very, very thankful for your time.
Thanks.
Because
It's
normally you
it's
have to
good to
pay a
be here.
lot for a CPA's time during tax season.
You know,
So,
I learned a long time ago that life doesn't stop just because it's tax season, and I'm really
yeah,
glad to be here. This is the good stuff.
well, you got a lot going on at home too. So
Yeah.
anyway, with that being said, we should jump in because one, we got going a couple minutes late, and that is my fault. So to the people that are here with us, my bad. Um, and number two, I have to give a disclaimer. I actually I'm dressed a little maybe down for an event like this. Um, I just got done recording a podcast with Chad Greenway, and I had a Vikings jersey on because I had to like you know and I had a Hawkeye hat on, and I did the whole bit. I loosened it up a little bit for the Inner Circle workshop here, but, long story short, you should listen to the podcast because we got Chad Greenway on there. Today's about taxes, though, so if this is your first ever Inner Circle workshop, I promise you there's actually real content. We're getting there, but we always start with a couple housekeeping items, and so we're gonna start with housekeeping, and then we're gonna take a fun and friendly quiz. This quiz is not graded individually, so don't worry if you don't know the answers. In fact, I hope you don't know the answers to some of these questions because it means you're going to learn something today. And so we're going to have you take this quiz. We give you about 4 or 5 minutes to take it. It's about 10 questions. Carly and I will shut our cameras off, just let you take the quiz. We didn't leave. We just don't want you staring at our blank faces while you're trying to answer these questions. We'll come back, and what we're going to do is we're just going to go through the quiz together, all 10 questions, and and do our learning that way. So that's how the Inner Circle workshop works. But these updates, housekeeping items, whatever you want to call them, first and foremost, we're using a new platform called Riverside. And so this is only our second time doing this. I give that disclaimer because if we have any technical difficulties, I'm just asking for you to bear with us. I promise you this is a better platform, but it's like a new toy that we
Mhm.
haven't worked all the bugs out of yet. So I'm hoping we don't have any technical issues today. But I did want to give that disclaimer. Upcoming Fiat events. So we have a happy hour coming up on March 10th. That's from 4 to 6 p.m., and that is at Loose Line Brewing. Loose Line Brewing. If you've never been to a Fiat happy hour, there's literally no agenda. That's all it is. If you ever gone to your friends for a happy hour or met at like the Muni in Wyzetta for happy hour, that's essentially what it is. The difference is there's hopefully more people at our happy hour than just you and a friend. And number two, we pick up the tab. There's no agenda.
Mhm.
There's no speaking. You don't have to like bring a friend. It's just an opportunity to get like-minded people together. One of the things that's super important to me is community. And at the end of the day, one of the hardest parts about retirement is community. 'Cause a
Mhm.
lot of people found a lot of community in their employment. And so we try to be a bit of a bridge builder and help you find like-minded people and just hang out and have a good time. And I'm a little biased, Carly, but I think that
Mhm.
the team here at Fiat is pretty fun to hang out with. So if for no other reason, come to Loose Line Brewing on March 10th. If you don't remember all the details or you want to RSVP, it's all on the website, fiatwm.com. Also, in April, we have a Wine and Wisdom event coming up. That's April 21st from 4 to 6 p.m. Location TBD. We're still working on a location for that. Will not be here at the office. It'll be somewhere on location. All that stuff can be found in our Fiat Focus. So if you're on our email list, that's what we call our Fiat Focus. We only send one email a week. We will not spam you with a bunch of emails. If you're not on that, please ask to be added. If you are on it, the information can be found there or on the website, like I said before. Wine and Wisdom events, you guys, are referral events. They're an opportunity for you to bring a friend to an event. It is not a timeshare presentation. We do a little bit of a financial talk. It's 10 to 15 minutes long. But the best part is there's also wine. And one of our best friends here at Fiat, Marcus Hansen, is always there. Marcus, if you've not yet met him, is a professional opera singer and a sommelier. And so he brings some wines. We talk about the wines. He educates us on wine. So we get a little wine education, a little bit of financial education, and overall just a fun event. And always food. There's got to be food. So we do have food at those events as well. And lastly, well, actually, I have two more things. Kaylee is going to be sending, if you don't know Kaylee on the team, Kaylee Schmidt is going to be sending the recording of this out afterwards. So we get that question a lot. Hey, is this recorded? Can I get the
Mhm.
recording? The answer is yes. It is being recorded, and we will send that out afterwards. Again, if for some reason you're not on the Fiat Focus newsletter, email, just let us know, and Kaylee will get you added back because that's where she's going to be sending that out. Here is the last thing. Uh, Another way to find out all these details, education information, or just want to see what goes on around our office, you should follow us on social media. We have raised our social media game. We are a player in this space now on Facebook, Instagram, and LinkedIn. No TikTok, Carly. I haven't been able to get into the TikTok yet. I don't. I
I
don't know
really
if.
want to see you on TikTok.
Oh man, I've
You could do
never
some
logged
dance
in.
moves, some Fiat
I see.
dance
That's why I
moves.
thought TikTok was all dancing. Is that not
Yeah.
true?
I think there's
I don't
quite a
know.
bit of financial advice out there too. You don't have to
Well,
dance.
I've never been on TikTok. I'm kind of like I'm protesting it, I guess I would say. So with that being said, we're going to start the quiz now. And so, Kaylee, if you want to go ahead and pull that quiz up for us on your screen, the quiz or poll or whatever you want to call it is going to come up. We're going to give you about 4 or 5 minutes to answer these 10 or 11 questions. And Carly will be back and dump some wisdom on you. So see you all in a couple minutes.
Mhm.
Some of you are rocking and rolling through this. I just wanted to give you your 2 minute warning. Some of you are done already. Very fast test takers. I love that. But about 2 minutes. All right. I'm gonna call it. If you didn't get all the way through the quiz yet, no big deal. It's a fun and friendly quiz. It's just other than Carly and I just kind of blabbing at you guys for 45 straight minutes, this is just a way to break it up a little bit. So again, meant to be fun and friendly. And so we're gonna start off. We're going to go right to question number one on this poll. Carly, why don't you lead us? Why don't you lead us off here? Question number one.
Great. All right. So our first question was, what does the SALT deduction allow taxpayers to deduct if they itemize? And I don't know, am I supposed to be able to see
Can you
all
see the
the
poll? I can
answers?
tell you. Um, it says question number one: 87% of people said B, state and local income taxes. We had a couple people guess federal income taxes, a couple on the mortgage principal as well. But the majority of our listeners today said B.
Great. Well, that's a good start. That's a good start because B is correct. For those of you who answered A, that's actually a really common misconception. So you pay federal income taxes, you do not get to write off the payments that you make to the IRS.
We should.
We
I,
should,
so
shouldn't
I
we?
like their answer.
It would be it would be this nice circular deduction that just keeps
Yeah.
on going. Be great. But you can write off state and local taxes that are paid. That is, if you live in a state that has income taxes, it's your income tax payments, but it could also be sales taxes. It can be property taxes you might pay on a vehicle. And then it's also real estate taxes that you pay on your home. So all of those items together can be a deduction if you itemize.
Wait,
So
so
that's
you
really,
brought up something in there, Carly, that I have a
yeah,
question on. Because you
yeah.
said, I think this is how you said it. Property taxes on a vehicle?
Yep. So when you register your vehicle, to the extent that the registration fees include like a value-based tax,
Yeah.
that also can be deducted on your return or included in this like SALT deduction.
So your
But as
car
we're going to
tabs.
be, yeah. But as we're going to be talking about, historically that SALT deduction has had a cap.
Yeah.
And so for a lot of clients, I feel like the vehicle tabs didn't matter because they were already subject to the cap. So tracking that tax didn't really make a difference anyway. But if you were below the cap, then yes, that could be an incremental, value to you. You could write that off in addition to your property taxes on your home,
Yeah.
sales taxes, income taxes.
It's very so the history, I mean, prior to the Tax Cuts and Jobs
Hmm.
Act, there was no cap at all. Like you, whatever, and in a high tax state like Minnesota,
Hmm.
or California or New York,
Hmm.
they capped it. There's a lot of good things that came out of the Tax Cuts and Jobs Act that
Hmm.
net made put better people in a better spot. But this is one that was painful for Minnesotans, because if you just to use the simple one, state tax and property tax. If you have a $40,000 state tax bill and 10,000 in property taxes, well, that was a $50,000 deduction.
Mhm.
And all of a sudden it went to 10. To your point, now with the One Big Beautiful Bill Act, such a ridiculous name. Um, and it's
I
not
heard
even an
someone call
easy
it the
acronym to
OB3.
say.
I
Oh,
heard
there
someone
you
else
go.
call it the
I've
OB3.
okay. So that's what I was just going to say. It's not even an easy acronym, OBBBA, but OB3.
Yeah.
That's
Mhm.
sounds like a Star Wars character.
It does. It does. I kinda
Um,
like it.
yeah. So now they've increased it back. Well, there's still a limit, but it's up to 40K um, that you can deduct. But there's there's a catch.
There's always a catch.
Yeah.
There's always a
What's
catch.
the catch?
The catch is that it's subject to income phase out limits. So once your income on a married filing joint return is over $500,000, it starts to phase back out and go back down to that $10,000 cap. Once you've hit $600,000 of adjusted gross income on a married filing joint return, it's fully phased out. So it goes all the way back down to that $10,000. So
And
for
what are
some of
those
our
numbers for a
high
single
income
filer?
clients, sorry, what was that?
What are those numbers for a single filer? Is it exactly half of that?
Yeah, it's half of that. Which the other thing that's very interesting about this SALT cap is the SALT cap itself actually does not change whether you're single or married filing joint. So it's not, hey, it's a $20,000 cap if you're single and a $40,000 cap if you're joint. That part actually stays the same. So it actually hurts you in the case of being married because the cap doesn't double.
Yeah.
And it's the same thing at the
What
$10,000 threshold. So the $10,000 threshold stays the same, single versus joint.
which is unique, I feel. Again, the
It
tax
is.
code, it isn't usually that way. Usually is there's
Right.
more room for a married couple, and this is one of those situations where there isn't. From a planning
Mhm.
perspective, before we get to question number 2, what I hope you're all taking from this is there are definitely people that took a standard deduction last year that will itemize this year based on this change alone.
Mhm.
And so understanding that it's funny, Carly, because to me, it's one of the easier quote unquote places in the tax code, or
Mhm.
one of the easier concepts is this idea of deductions and itemizing. And
Yep.
but in spite of that being true, I feel like it's one of the biggest places people miss, or at least misunderstand. Um, and so with this pretty dramatic change here of
Mhm.
4x
Mhm.
increase in the cap, um, some planning opportunities, some things to think about. So
Yeah.
especially in a state like Minnesota.
Well, I know at year-end planning with a lot of our advisors, the meetings that I was in, that was a big topic of conversation was, should we make,
Yeah.
if you're gonna owe to the state and you are, below this income threshold where you can take advantage of a new $40,000 cap, well, maybe you should make your fourth quarter state payment by December 31st
Yeah.
so that you could increase that deduction even more because you were gonna make the payment anyway. But now
Yeah.
we've got it into the 2025 year. So it's also a really great planning opportunity if we are looking forward, looking at how much income is going to be on your return and can confirm that you're going to be eligible for that 40,000 cap. Now we can really, do some more aggressive planning.
Mm. See,
Mhm.
that's the kind of stuff I love.
Yeah.
This is why you do what you do. Um, I love that. So let's go to question number 2. Mary Sue and Larry. Mary Sue is the
Mhm.
name of my second grade girlfriend, just so you guys know. Mary Sue and Larry itemized deductions and pay high property taxes. I know everybody wanted to know that. I'm trying to
I
keep
was
it
going to
light.
say,
It's
I'm so glad I
taxes.
know this.
um, Itemized deductions and pay high property taxes. What changed
Mhm.
beginning in 2025 that could increase their deduction opportunity? Okay. So the second, this was across, we had all 4 answers were answered at least once.
Oh.
Salt was eliminated, uh, was only 6% of you. The deduction became available to non itemizers. That was 21%. The majority of you said C, the salt cap temporarily increased. And that is the correct answer. So far, you guys as a group, because we grade on a curve, we grade as a group. We're socialist as it relates to our fun and friendly quizzes. We do this together. The correct answer is, in fact, C. See, Carly, can you talk to me about the temporary aspect of this?
Yeah. So, whenever we pass legislation, tax legislation, especially when tax legislation is what we call a reconciliation bill, which that's what the OB3 was. Um, the bill in the end cannot increase our deficit. So that means there
Mm.
have to be winners and losers. And oftentimes there also have to be a sunset to some of these provisions. So there will be times where, hey, we give you like an additional deduction or some additional tax savings in the code, but that is going to reverse. And it has to reverse so that they can make the budget reconcile because they cannot add to the deficit, which is a really unique kind of
Yeah.
thing to understand when it comes to legislation. And not all tax legislation is a reconciliation bill where they have to make the budget, kind of stay in balance. Tax Cuts and Jobs Act was a reconciliation bill as well. So both of
I
these large.
see. If anybody listening learned something from that, I'm with you. I didn't know that. I didn't know that that it was the record because it was a reconciliation bill that this is kind of one of these concessions. And so it's not permanent. When does it expire?
I believe I want to say we're at 8 years out, but let me confirm. Oh no, I'm sorry.
Putting you on the
We're at 4
spot.
years out. You're going to put me on the
Yeah.
hot seat. 4
Yeah.
years out.
Well,
4 years out. Tax Cuts and Jobs Act was 8 years.
yeah. Yep.
We're at
So we
4
got
years.
4 years to take advantage of this. And so again, being
Yep.
in a high tax state, this is something that there's kind of a donut hole, a window of time of opportunity. And so the planning that you do, and this isn't the only thing that was in that bill that was
Mhm.
temporary. There's other
Mhm.
things that are in the bill that are going to be around for a couple of years and then go away. And so what I would say from a planning perspective is what it's done to our, we call it a tax timeline. When we kind of think through every year of your life and
Mhm.
kind of, there's milestone moments relative to your age. There's milestone moments relative to accessibility to things like Social Security or Medicare, RMDs, things of that nature, that the type of planning that's done is going to be based on where you're in on that tax timeline. Now we have this
Mhm.
additional kind of complexity added of, well, the game changes, but only for a period of time. And then it reverts back to what it was before, SALT being one of them, that we're going to lose this ability to have up to 40K. And so there's going to be certain families, and we've had a handful of them already, Carly, that we've talked about, where
Mhm.
what was plan A prior to the OB3, thank you for that, um, is now plan B because plan A had to change because the law changed.
Right.
And we got to take advantage of some of this stuff for some of these because it's a big deal. I mean, if you think about what, being at a 24% federal
Mhm.
tax rate as an example, and you have an extra 30K you get to write off, that's an extra $7,200 if my math is right
Right.
of
Well,
taxes saved. That's real money.
yeah, and it's, a lot of times we talk about tax deductions, like, for example, charitable donations. Well, it requires you to spend money in order to get that deduction. This is something
Mm,
you are already paying. You are already paying these state taxes. You just weren't able to take advantage of writing them off.
yeah.
So it
Not that
gives you
you
the tax
wanted
savings
to, but
without
you
a
did already pay them.
yes,
Yeah.
right. Hopefully. Hopefully you did.
Yeah. Um, all right. Question number 3. In 2025, Ben considers purchasing a qualified electric vehicle. Why does timing matter
Mm.
for him? 94% of people, Carly, said B, the clean vehicle credit is scheduled to phase out after September 30th, 2025.
I
Did they
think
get
we've
it?
got to give them harder questions, Brad. Uh,
Well, yeah. When I'm
the
looking at this
success
one,
rate here.
so this is how you get through tests though. Because if you look
Yeah.
at the other three, gas prices
Yeah.
are deductible, EV insurance is tax deductible,
Yeah.
EVs eliminate state taxes. The B is so specific. The clean vehicle credit is scheduled to phase out after
Mhm.
September 30th, 2020. That has to be the right answer.
Yeah.
This is how
Unless,
you get through tests, even when you don't know the answers to the test.
I mean, unless you just have a really cruel teacher. Just like
Yeah, that's true.
add some
But these are
specific dates
fun
in
and
there.
friendly quizzes. These
Yeah,
aren't,
that's true. That's true.
I'm not the professor that's trying to fail half the class.
Yes. Well, I mean, we're already in February 2026. So it's an interesting
Yep.
conversation to have. If you haven't purchased an electric vehicle yet, then obviously this credit is no longer available to you. But I do
Yeah.
think it's an interesting conversation because really what this highlights is just the conversation around kind of life planning and choices, things that you have going on in your life, and tax code. And if you're working with, an advisor and a CPA that are really proactive, you're learning this information in advance so you can make those
Yeah.
decisions timely. Um, I will also add that the electric vehicle credit, it's existed for many years. It changed a couple years ago, and it
Yep.
actually was limited as well by income. So when you're on a married filing joint return, if your income was over $300,000, you phased out of being able to claim that credit. And then the other thing that was kind of unique about it is that you had to tell the dealership when you bought your car that you were going to be claiming the credit. Because if you didn't tell them that and they didn't, then they wouldn't have to pass the credit along to you and they got the credit for themselves. So
No
I
way.
actually, it was like this shady, because the way that the new credit was set up was so that people who were buying a car could like negotiate with the dealership and that they could build the price into the car that when the dealership sells it to you, and then they would just get the credit. That way you didn't have to wait to file your return to get your money back. So that was the
Hmm.
theory behind it. But a lot of people didn't know about it. And I had 2 clients last year that got burned because they just thought they were going to get the credit on the return and they hadn't told the dealership. And so they paid their price for the vehicle and the dealership got their money and there was no fix for it. Like, it was,
Yeah.
even the IRS put out a thing about it. Like, we understand this is a problem and we don't have a solution. So maybe it's good
The
that the electric
the
vehicle
IRS
credit
has
right
never
now is
said
done.
that before.
Yeah.
Yeah.
Yep.
They've never
Mhm.
said that before. From a
Yeah. No,
bigger
no,
planning
never.
perspective, even if you're not an EV person, never going to buy an
Mhm.
EV, the point is well taken, Carly. There's plenty of things inside of the tax code you may not understand, and if you didn't know about
Mhm.
it ahead of time, you're just going to miss out. And so,
Right.
EV or otherwise, before you're making kind of bigger decisions like this, always good to ping your advisor. If you're working with us on the Fiat Tax side, Carly and her team directly,
Mhm.
and just see. Is there something that I should know about? I mean, because as an example, there's still energy efficiency credits for your home, things of that nature, that are just worth knowing about. And if you don't know, how are you supposed to do anything about it? So awesome. Number
I had
5,
one more thing to add on that car loan
go
because,
for it.
we're saying the electric vehicle credit phases out, which it does. There is another new deduction that's on the table. So, normally as part of itemizing, you could write off the interest on your home.
Hmm.
Um, as part of the OB3, there's now a new deduction where you can write off the interest on a new car loan. So that's doesn't have to be an electric vehicle, can be a standard car, but it has to be a new car. And you can write off the interest in addition to your mortgage interest. It's up to $10,000 of a car loan interest deduction, which is a lot of interest
Yeah,
on a car
that's a
loan.
lot.
That's a lot. Um, but it's also subject to income phase outs because of course they are, and these are lower. So 100,000 on a single return, 200,000 on a joint return.
So 100, 200K phase out, up to 10K of interest deducted
Hmm.
per year.
Per year.
Yeah, but it has to be a new vehicle.
Has to be
Can't
a
be
new
used.
vehicle. Correct.
Yeah.
Correct.
All right, I found question
Okay.
number 4. They seem out of order on my side for some odd reason, but I found it because I'm a tech genius over here. Um, Question number 4: What commonly happens to certain tax deductions and credits as income increases? The overwhelming majority, 88%, said they phase out or become unavailable. And
Mm.
if you don't know it already, because we haven't brought it up 7
Yeah.
times, that is the correct answer. It is
Well
C. They
done.
phase out or become unavailable. So a lot of times when they put these
Hmm.
reconciliation bills out, the way that they can reconcile one is by it's only for a certain period of time, and
Hmm.
eventually that additional deduction or credit goes away. Another way that they do that commonly, Carly, is
Hmm.
it's all income
Right.
adjusted, or there's limitations on income.
Right.
Um, so that's not a new thing. There's all kinds of things in our tax code where things phase out. Like, as a parent, as an example, there's child
Hmm.
tax credits you can get; those all phase out.
Hmm.
Social Security tax, that how you pay tax on your Social Security is all based on your provisional income, which is essentially an income phase out. Just off the top of your head, what are a couple other couple
Um,
other areas that we haven't discussed that have phase outs on them?
well, it's not, it doesn't change your tax answer, but Medicare. We talk a lot about
Yeah.
how your income changes the Medicare rates that you pay.
You phase in to higher
Yeah, exactly.
to
Exactly.
higher premiums.
Well,
Yeah.
it's similar to Social Security, right? You phase into paying
Yeah.
tax on your Social Security. So
Yes.
you phase into higher premiums. Yeah, child tax credit is the other one I was gonna say that's like the more common one I think that comes up. Student loan interest that phases out once your income's over $180,000 on a joint return, 90,000 on a single return. College tuition credits. So if you have kids in college, those credits phase out once your income's over 180,000 on a joint return, 90 on a single.
Big
Um,
one for a lot of
mhm.
pre-retirees and retirees is healthcare. private
Yep.
healthcare and the advanced, premium tax
Yeah.
credits that you can
Mhm.
get. That one's really goofy, uh, in my opinion, of where it phases in and phases out because it's like a donut hole. Um, Correct me if I'm wrong on that, because the last time I
Yeah, it is. So the it, you actually it's a weird one in terms of phasing in and phasing out. You would just think like, well, if your income's low, of course you'd get the credits.
yeah,
The theory there is that, you should be on some sort of maybe Medicaid or other assistance program if your income truly is that low
yep,
rather than through the marketplace. So that's the reason that it happens that way, but it does seem counterintuitive. You would just think like as long as your
yep,
income's below a certain threshold, you get the premium tax credits, but your income can actually be too low where you don't get
yep.
those credits and that's why.
I will just say of all these opportunities inside the tax code, if that's what you want to call them,
Mhm.
the tax code is basically set up to incentivize behavior. There are a lot that directly affect pre-retirees and retirees.
Mhm.
There's a ton that affect business owners, but from a planning perspective, these are a lot of things we plan around every year. Is these tripwires that exist where, hey, we can get this really cool credit or deduction, but only if your tax return looks this way. But
Yeah.
then if we make it look that way, then maybe we miss out on a different credit somewhere else because we're trying to play a game over here. So now we're robbing Peter to pay Paul. And like private healthcare can be one of those. If you're lucky enough to retire early,
Mhm.
and you're not 65, you can't get Medicare yet. So you have to go out to the private market and they tell you your premiums are $1,300 a month. And you're like, what? Um, it's possible if we make your 1040 look the way that the IRS wants it to look, that we could get a lot of that refunded through a tax credit. But then, of course, we're missing out on other opportunities we could be taking.
Mhm.
And so it's always that game you have to play of knowing all the rules to the game. It's kind of like chess. Every time you move a piece, there is going to be a positive to that move, but there's always
Mhm.
usually going to be a negative too,
Mhm.
right? And so, how do you just make the most efficient move, knowing net kind of how it plays out for your family? Um, I got to be honest, Carly, it's the only reason that I find this job fun is because it is a chessboard, not a checkers board.
I
So
mean,
I
it
don't know
is.
if you feel the same way, but
I agree. I mean, I think kind of all those moving pieces are very interesting. We work with a lot of business owner clients who happen to be in the highest tax brackets. And that's hard too, because you're consistently in the high tax brackets where it's kind of always phased out. And so there's some different planning that we can look at
yeah,
there. But it is when we have control, like if we're talking about timing of Roth conversions or when we're going to pick up income on a return, and we can look at all these other variables too at the same time. I mean, that's really where the value can come
yeah,
into play in planning.
awesome. All right, for the sake of time, I'm going to keep moving. We're a
All
couple
right.
minutes behind, just based on how many questions we have, but that's okay. We'll get through this. Samantha sold investments this year to fund a home renovation. What most directly determines how much tax she owes on those sales?
Mhm.
Um, Nobody said B or C, how often she reviewed her portfolio or whether she uses an
Mhm.
advisor. So kudos to you for that. 18% did say the renovation cost. The correct answer, 82% of you nailed it, when the
Mhm.
investments are sold. So if you're keeping score at home, you guys are 5 for 5,
Yeah.
and are you know globally graded test here. And I do want to throw this out. I should have said this at the beginning. There is a chat feature on the right hand side of your screen if you want to chat with us. If you have any questions, we did get quite a few questions right at the beginning. Some of that was, hey, are you guys starting? Because we
Yeah.
were 2 minutes late. So some of you did find the chat function, and I appreciate that. But I did just want to throw that out there. So um, anyway, the vast majority of you got that one correct. It's when the investments were sold. Um, Carly, what additional insight or thoughts do you have here?
I would say, I mean, I think it is when they're sold, also when they were purchased. So what we're
Yeah.
talking about here is,
Ah,
holding period and whether something's short term and versus long term. Because short-term capital gains are taxed at ordinary income tax rates.
yep.
Long-term capital gains get lower rates. For those of you who maybe aren't aware or haven't had to really think about this, we have two tax rates in our system. We have three if we count AMT. But there's ordinary income rates. And those are the standard brackets when people say like I'm in a 35% tax bracket or 24% tax bracket. That's really what they're talking about. They're ordinary income rates.
Yeah.
That's how your, interest, your W-2 earnings, your pension, retirement, Social Security are all taxed at those rates. Capital gains typically from the sale of investments and then qualified dividends, have a different tax structure. But the capital gains have to be long term, so they have to be held for more than a year. And I think just like we were talking about on the previous question in terms of phase outs and how income can affect deductions and credits, looking at the timing of when you sell an investment and when it might throw you into that next tax bracket, and
Yeah.
whether it's going to be in those or in an ordinary income bracket or a capital gains bracket,
Yep.
all plays into that total tax planning, conversation that we're having with clients.
Yeah, the timing, timing is one of those things where anytime when you look at those three tax buckets that we have,
Mhm,
pre-tax, post-tax, and then the
mhm.
tax-free bucket. When you go away from the pre-tax bucket and you get into this after-tax or tax-free bucket, there's the potential to get a preferred or preferential tax rate relative
Mhm,
to ordinary income tax rates. But the caveat to that, and the easiest way I like to think about it, Carly, is there's always a time commitment. Hey, if
yep.
we're not going to make you pay full boat retail ordinary tax rates, you can't just get this at any moment you want. And this after tax bucket, which is what we're talking about in this question, in most cases, it's a year, right? So got to hold on to it for a year. Roth IRA, you want tax-free growth, it's 5 years that we have to hold on to it. And again, there's some
Mhm,
details to that that should be uncovered in a conversation with your advisor because the 5 years has some caveats, as does the 1 year with after-tax investments. But all that to say this, the timing matters when you get in, when you got out, but also going back to a previous massive piece of
mhm,
legislation that we've already brought up once in this conversation, the Tax Cuts and Jobs Act. Also important to note that every time you add a dollar to your ordinary income tax side of the code, it adds into the the brackets or buckets, as I like
mhm.
to call them, on the capital gains side. But
Yep.
it doesn't go the other way. And it hasn't always been that way. And so you can
Mhm,
bring in capital gains into your life and have significant capital gains and still be in a
mhm,
10 or 12% ordinary income tax bracket. And so, again, from a planning opportunities standpoint, when we're looking at how to devise income in retirement, or I've got that home project and I need 50K, I need to raise $50,000, and we're a family that's already doing a Roth conversion. And so we're already messing around with the ordinary income tax brackets, and we don't want to bump ourselves into another bracket we don't want to be in, or there's an IRMA bracket for Medicare that we're trying to
mhm,
avoid, which that's all based on adjusted gross income. So that one's going to matter. But these ordinary income tax brackets, it's important to note. We've got I've seen an extreme example that it makes my point, Carly. I've seen a
mhm.
return where somebody had over $1 million of capital gains on their return, and they were in the 12% ordinary income tax bracket.
Yep. Yep.
So
Their capital
they
gains
were
were
like,
probably
"Well, I
were
don't think I
in
should do a
the
Roth
20%,
conversion."
right?
Yeah,
Yeah.
yeah, and they were like, but they were the person. They're like, "Well, my adjusted gross income's way too high, so I shouldn't be doing Roth conversions." I was like, "Well, actually, on
Yeah.
the ordinary income tax side,
Yes.
they're, and this was a very wealthy person that it isn't
Mhm,
used to being in those tax brackets." So, anyway,
mhm.
tons of planning opportunities. We could go down that rabbit hole for a very long time. So let me go to the next question. We are on question
Six.
7,
Oh,
6.
7, yeah. No, 6.
Nope, 6. See,
6.
that's you're the brains of the operation.
Yeah.
Question number 6. Which type of retirement account allows qualified tax-free withdrawals in retirement?
Mhm.
Qualified tax-free withdrawals in retirement. 94% of the people got this right. It is a Roth IRA. Um, Again, I'm gonna let you start because you're smarter than me. Add your 2 cents to this, or add any planning opportunities that you see, and I'll follow you up.
Well, I mean, I think you just mentioned the 5-year rule. So
Yep,
you can't you can't take that money back out and have the earnings be tax free if it's been less than 5 years. But assuming you've hit that 5-year threshold,
yeah,
you didn't get a deduction when you put the money in. When you take the money out, you now don't have to pay tax on the what you originally contributed, but also on the earnings. So that's a
right.
really significant piece, right? There are lots of things where you get your return of your initial principal that you put in, but you still pay tax on the earnings. And in this case, you don't pay tax on the earnings either as long as it's been in there for 5 years.
I mean, when you think about investments, I always tell people it's like giving your money a job. Like money that's
Yeah.
sitting in cash is a unemployed
Yeah.
pile of money. It's not out there working for you. Like
Right.
it's really good in a lot of situations. Not that you should have cash. Don't run away from this workshop and be like, Brad says no cash. That's not what I'm saying. But if your money has a job, you should not only ask for your money, hey, what kind of job are you getting, but how are you taxed on this job, the
Mhm.
income that you're going to go earn for me? And in a Roth IRA, to your point, it's possible that if they get a good paying job and they make a lot of money, your money makes a lot of money, that you don't have to pay any taxes on that. The caveat is 5 years. It's different too, Roth conversions versus Roth uh, contributory IRAs
Mhm.
and how that 5 year clock works. And so you got to be very careful with that and understand that. But the other planning opportunity here, and this is really important for people to understand, is every year in your retirement, as an example, could be different relative to what your 1040 is going to look like or
Mhm.
what we want it to look like based on kind of, again, this tax timeline of your life. There is no line on the 1040, Carly, for Roth IRA distributions. Said differently, it's off the grid. It's off the grid money. And so if we
Mhm.
get to the end of the year, we've done a bunch of planning, we've got our Roth conversions dialed in, we've done that, we've got
Mhm.
our capital gains where we want them, interest income, all that. We've curated this tax return and it's beautiful. It's exactly where we
Mhm.
wanted it to be. And then all of a sudden, something comes up and little Johnny gets in trouble, your 18-year-old grandson, and you need to pull 10 grand out of an investment and it's going to kind of screw up the whole plan. Well, if we have Roth IRA money, it's possible that it won't,
Mhm.
because we can pull 10 grand out of the Roth IRA and it doesn't touch your 1040. And so having kind of that dry powder sitting around just as an option, from a planning perspective is really important. It's like having cash reserves. It's one of the reasons why you should have cash, is just in case things come up, that I've got dry powder laying around to go take care of these financial needs. From a tax perspective, a Roth IRA is dry powder for people, kind of in it from a planning perspective. And
Mhm.
so just understand the 5 years, understand where the 5 years started for you, if it was contributory account or conversion Roth IRA, and what that looks like. But um, yeah, I'll punt on that
Mhm.
because again, what I'm finding here, Carly, is we could talk about a lot of these questions for a very long time.
We
Question
really
number
could.
7: true or false? See, we're getting to true false. These are my favorite types of questions. I'm really good at true false. Um, Filing a tax extension gives you more time to pay your taxes owed. Now, 30% of people said true, but that's not the majority. The majority of you did say false, 70% of you, and that is the correct answer. Carly, big misconception here.
Yeah,
Um, Fill
it
us
is a
in.
big one. I actually very common for people to come to me and say like, "Hey, I don't really have the cash flow right now for my taxes, so can you just file an extension for me and then I can pay my taxes later?" And again, it's a misconception. An extension gives you an additional 6 months to file your return, not an additional 6 months to pay. So,
Mhm.
your taxes really are due to the IRS throughout the year, but if there's any additional balance due with your return, that is due by the due date of the return, April 15th. If you take longer to pay, the IRS can charge you interest because they've effectively given you a loan, and they can charge you penalties. So, we want to pay on time. When we file extensions for clients, we actually are doing the work to calculate here's what you should owe with your return so that we can make a payment on time. And then the 6 months really is to give you time to gather documents. So maybe you've got an investment and you're getting a K1 and that comes late. Maybe
Yeah.
something changed in your life. Maybe, I mean, I've had people that they have a family member pass away. They just don't have time to get their stuff together. They have a major life change. They move. There's just things that happen
Yeah.
in your life. And there are times when it's actually really good to just take some time, gather all of your documents in a thoughtful way, and have space to file rather than just trying to rush. And so we file an extension to give us
Yep.
that space.
So 2 things I wanna point out here, Carly. Number 1, it's not bad to file an extension.
Oh, no.
There's like this, I don't know what it is. Like, there's some people that are just like, I would never file an extension, or it's
Yeah.
bad to file an extension, and it's just like,
Yeah.
why? It doesn't, it's not gonna hurt you. It's
Mhm.
completely legal, by the way. Um, and so some people like to be in the front of the line when
Mhm.
they're, you know, and they like to hurry up and get it done. And I get that. Nobody wants to just have this hanging over their head of
Mhm.
this true reconciliation. But the second thing, and this is more of a question to you, is let's just say you go through this process and you have somebody that let's just say they did have a death in the family and so
Yep.
they just don't have time to get things organized, and so you do the math to figure out what you think they should probably owe.
Mhm.
You pay that bill by April 15th, but you filed the extension, so you got 6 more
Mhm.
months. During that 6 months, you do all the finalization, you get all the documents, you actually file, and you realize that the work you did in April was wrong and that it's not the exact number that they owed. and
Okay.
now they either get money back or they
Mhm.
have to pay more.
Mhm.
Let's just say it's to pay more. Do they then have a penalty, or how does that work?
There's still penalties and interest because your taxes were due in April. So if you have to pay more once you actually file your return, again, you've had the benefit of holding onto your money for longer. So the IRS is going to charge you interest and they're going to charge you what's called a late payment penalty.
Yeah.
Now, if there was like a reason like, hey, we moved, we lost access to our records, a family member passed away, natural disasters are also a really common one where you get extensions of time. You can request a waiver of penalties under reasonable cause. So
Hmm.
you can essentially get penalties waived if there's a reason. Like, hey, we did our best to estimate. If we have clients that come to us and we really have no idea, or like we're making a lot of assumptions about where income is going to fall for the year, or they're new clients to us and we don't know, then oftentimes we'll talk to clients about like adding a little buffer in. Because if you
Yeah.
overpay, so if it's the opposite, if you paid too much in April, then when you go to file your return on extension, you get money back. The IRS will pay you interest then. So if you overpay, you will get interest. That's not always the case, but in the case of because your money would have been due back to you by April 15th, and so if you file on
Hmm.
extension and you don't get your money until October, well, they pay you interest for how long they held on to your money. So
Yeah.
we try to add a buffer. Not every client wants to do that, and they're okay with maybe taking a little risk or having a little exposure and paying less. But that's kind of the goal, is to put a little covering on top of that
Yep.
just in case.
What I hope you're taking away from this question, listeners, is that one, extensions are bad, and two, life happens, you guys.
Yeah.
If I know we're all scared of April 15th, the IRS has done a very good job of,
Hmm.
breaking us into submission through fear of what could possibly happen if we don't get it done by April 15th. But you really do have an extra 6 months,
Hmm.
and there is a way to play that game. And the worst case scenario, to your point, is you overpay. They sit on your cash, but they're going to pay you a little bit of interest anyway.
Yep.
And so I love the margin of safety that's built into that planning. Um, Good question. Hopefully, everybody learned something from that. That
Hmm.
if you decide in March that you're like, hey, this Fiat Tax team and Carly seems super smart. We're not working with them right now, and we want to work with them. The
Hmm.
odds that we get your tax return done by April 15th, they're almost zero.
Yeah.
And so we're probably going to tell you on March 15th, hey, you're late to the game. We got all these other clients. We'll do it, but we're going to have to file an extension. It's
Mhm.
not a big deal. It's not a big deal.
No,
We'll
it's
get
really
it
not.
done. You want to do it right, not quickly. So question number 8, another true false, 2 in a row. Here we go. We're rolling now. Most tax planning decisions must be made before December 31st in order to count for that tax year. Now, a little bit vague here, but it does use the word most. 6634 was the
Ooh,
breakdown of true false here.
okay.
66 was true. Carly, is it
Well
most?
done. The majority had it right. You guys have kept the streak going.
Not all, but
But most.
most. So
But
so
most.
let's talk about the shorter list. What are the things that you don't have to have done by end of year that count for the previous year? Because that's a shorter list.
Mhm. Contributions to traditional IRAs, Roth IRAs, SEP or simple IRAs. So really like retirement plan contributions, you have until the due
Mm,
date of your return. Similarly, HSA contributions, you have until the due date of your return. And then for business owners, um, you can actually extend that even further. And those retirement plan contributions for business owners can extend to the extended date of the return. So we just talked about how
mm,
extensions aren't always bad. I have business owner clients who choose to extend every year because they want even more time to maximize their
yeah,
retirement plan contributions. And so it's a default, we go on extension just to play this kind of cash flow timing game. But
yeah,
most things, you're a calendar year taxpayer. Individuals by default are calendar year taxpayers, and by default are cash basis taxpayers. So that means you typically get the deduction when you pay the expense
yeah.
or pay the bill. And so that means it mostly has to happen by December 31st. But retirement plan contributions and HSA contributions are a perfect example of ones that extend past the end of the year.
What I would tell people is this, Carly, from a planning perspective.
Mhm.
I think the safest bet, and again, building margin of safety in here, so
Mhm.
you're not looking back on a previous year and be like, "Dang it, I wish I would have done X or Y,"
Right.
is to assume everything has to be done by December 31st. because then you're never going to miss. Right.
Mm-hmm.
And the list is so short of things that you can retroact to a previous year, and primarily driven by people that are still earning an income.
Mm-hmm.
That, as an example, for a retiree, for all intents and purposes, when the clock strikes midnight on December 31st, we turn into pumpkins and it's over. Right. So, and the IRS, that's not one of the areas where, you talked about the IRS giving you a little bit of
Mm.
grace, will pay you interest if you overpaid. This isn't, there's
No,
no grace here.
nope. You just get
Um,
it next year. You just get that deduction
yeah.
next year if you miss it.
I'm going to admit to everybody right now, I have a little bit of my money that I call my play account. It's not an it is investments, but it's not an investment account. You know what I mean? It's more of I'm playing around,
Mhm.
gambling a little bit. Um, it's not a lot of money either. Okay. So don't come at me as a financial advisor and tell me that I shouldn't. I know this is just my fun account. Uh, but I had this is my own money. I had two positions last year at the end of last year that I took it in the nose,
Oh,
and I thought about it in December. I was like, I should sell those and take that loss on my tax return. And it was a really good thought I had. Zero execution.
oh,
You know, when I thought about it again was on January 2nd. And I was like, dang
oh,
it. I totally
dang.
missed it and
Yeah,
didn't get the opportunity to do it. So see, this is why you have financial advisors. Um, because they're gonna remind you of this stuff. All
right.
right. Moving on. Question number 9. Why can upcoming tax law changes in 2026 matter before they take effect?
Mm.
We were a little bit of, 12% of you filing early avoids them, and 88% said C, some current deductions and provisions are scheduled to expire. Carly, if my math is correct,
Mhm.
they currently have an A plus. They are 9 for 9.
They are 9 for
So
9.
what is an
Those
example
are good.
of current deductions and provisions that are going to expire?
Okay. Well, I want to just also highlight that this question was asking about 2026. So the other interesting thing about the OB3 is that it had some tax law changes that happened immediately for the
Yep.
2025 year, like the salt cap deduction that we talked about earlier. And then there were other deductions that kind of have a delay or some things that phase out on a lag, and they started 2026. Um, the electric vehicle tax credit is kind of a unique one because it was part of the year for 2025. It's gone in 2026. Similarly, all the residential energy efficient property credits. So you install solar panels on your home, you put in new energy efficient windows or insulation, all of that, there were tax credits available. They were all varying amounts and had caps of their own, but those are gone in 2026. Another one I was thinking about, if we go back to itemizing deductions. So now we've increased our salt cap, and a lot of people are probably likely going to itemize now instead of take the standard deduction. And as part of itemizing, we get to write off medical, subject to some income thresholds, taxes, mortgage interest, charitable donations. In 2026, for individual taxpayers who are in the highest tax brackets, which is a 37% tax bracket, your
Hmm.
charitable donations now get a haircut.
Yeah.
And the way that the legislation is worded, it makes it very confusing to understand what the haircut is. But basically, it's a 2% haircut. So if you're in a 37% tax bracket, normally for every dollar you gave to charity, you would get a 37-cent deduction, tax savings. In this case, for those taxpayers in the 37% tax bracket, for every dollar they give to charity, they get a 35-cent deduction. That's how the calculation works. So it's for income purposes, you're in a 37% tax bracket. For charitable donation purposes, you're in a 35.
I will tell you, I think it's so ridiculous. This is where they
Yes.
chose to save money, and it's very confusing. Um,
Yes.
but again, there's a lot here, you guys. What
Mhm.
I want you to understand is that some of the stuff as you're filing right now
Mhm.
is already into effect for last year and is going to affect the filing that you're dealing with today. Some of the
Mhm.
stuff didn't phase in until this year. And so, long story short, the rules to the game changed last year. They change again this year.
Mhm.
And so don't just kind of blindly go into tax this year thinking, well, nothing's really going to change for me, so I don't have to do any tax planning. Well, that may be true for you, but it isn't true for Congress. So make sure that you're aware of this and that you're allowing us to build out these performas and thinking through, okay, as
Mhm.
some of this other stuff phases in, does that change any planning that we have for your family? And some of you, the answer is going to be no. I don't want to like scare you
Yeah,
into thinking this
yeah.
is for everybody, but it's worth taking a peek at. Um, because every time they come out with these new, I mean, the OB3, now that I
Mhm.
don't have to call it the OBBBA, uh, was like 900 pages long or some
Mhm.
asinine amount of pages. It's like, I don't know. So there's a lot there, and understanding it is important. We've got 3 minutes and two questions. Number
Okay.
10, the Fredericksons meet their CPA each March but are considering year end tax moves. Which action creates new tax opportunities? The second most common answer was reviewing last year's refund. That was 13%. But we had everybody answer every one of these. 3% said filing their tax return on time, 6% uploading documents to their CPA in March,
Mhm.
78%, the overwhelming majority, making financial decisions before December 31st. Carly, I think they get an
Yeah.
A for the day.
Well done. Well done, class.
Well done.
Easiest
You did
teaching
it.
job. You guys already had
Yeah,
all
we
the right
had
answers.
that's
Yes.
it. Next, I'm telling you, next inner circle workshop, we're gonna make it harder. So you guys aren't going to get 100% on us next time. I'm not going to let that happen. A little bit of context there. Any context you want to add to that? Why is it making financial decisions before the 31st?
I mean, I think, like we alluded to earlier, just knowing that the calendar year, for the most part, is when you get to include items in your income and also when you get your write-off. And so
Mm,
if you are planning before the end of the year and thinking things through and like being proactive, then you actually have a chance to move the needle. And if we
yeah.
wait, it's really hard when someone comes to me after the end of the year and then you're like, then they ask me, well, what can I do to get my tax bill down for last? And I'm like, well, I can't,
Yeah.
last year's done, but we can talk about 2026 now. So, and I think
The
that's a really
analogy I
hard
like to use here,
conversation.
Carly, is it's like you're
Yeah.
sitting in the restaurant, the meal has been served, you
Yeah.
had appetizers, you had drinks, you had your main course, you had dessert, and the table's just sitting there, all the dishes are empty, and the meal is over, and they come set the check down, and you open the little book, and you're like, ugh. That's a lot more than I want it to be, and I didn't plan on spending that much money on dinner, so what can we do about this?
Yeah.
And they're like, "What? No. You already
Right.
ate you ordered all the food and you ate it all. Like, no, we can't change it now. You should have planned ahead and known what you wanted to order, what your budget was, and you shouldn't have ordered the 4th dessert. Like, that's now it's too late." But by the time they come see you in, you know, February, March, April, whatever,
Mhm.
it's too late. It's
Right.
too late. And so this is the time of the year once our planning, our tax filing is done for 2026 or we're getting, or 2025, excuse me,
Mhm.
or getting close to that. It's already immediately time to start thinking about, okay, next, like, what am I going to do this year to kind of set things up so when that check comes at the end of the year, I may not like it, but I at least know what it's going to be,
Yes.
and we plan accordingly. So we have 1 minute left. I have one fun question left. The bonus question at the 2026 Winter Olympics. Have you been watching much of the Olympics, Carly? I know it's tax season, but
Not
no,
at all. Not a single one. The Winter
zero.
Olympics are really hard. They're really hard in
Yeah,
my industry. So
yeah.
I've like
In
seen some
Milan,
highlights. Like Noah will send me a little like, look at this video, watch
yeah.
this. That's about it.
Um, so at the 2026 Winter Olympics in Milan Cortina, events are being held across multiple regions of Italy. Which of the following cities is host? Which of the following cities is host? 76% of you said Milan. While you guys know the tax code very, very well, you're not as familiar with the Winter Olympics. We finally got you. The correct answer
Brad,
is
you got me too, by
Cortina.
the way. I did not know the answer to this question. So
The correct answer is B. 16% of you did get it right, but we're grading as a group. So as a group, unfortunately, we missed that one. It's Cortina as an Italian guy, I should know how to say this, and I don't. Uh, de Empezo? Empezo? Somebody's gonna come at me for that too, because I guarantee you I didn't get
seriously.
that right. But that is the correct answer. Um, Whoa, look at Kaylee just said, specifically the sledding events. See, that
Oh,
changes the question.
oh,
That changes the
oops.
question.
Our
Um,
question got cut off. Whoops.
Hey guys, we have a lot of questions in the Q&A. Our goal is always to answer all of those questions because we have them all and they're all recorded. If you're an existing family member of Fiat and you work with our firm, your advisor, your correlated advisor will get back to you with an answer to your question specifically. If you're not a client of our
Mm.
firm, somebody here will get back to you and answer your questions. That is our promise to you. There is a recording of this. I know some of you mentioned that it was a little choppy and we were having a little bit of problem with
Mm.
connections for some people. Just know that it is recorded, and so the recording will go out. I apologize for that. But again, we will get to your questions. We will send out the recording. And again, Carly, I just want to say every hour in tax season is a very, very valuable hour for you. And so I appreciate you being here and bringing your wisdom to the table. We had a lot of people in attendance today. We actually, you guys, we had to increase our seat limit um,
Ooh, love it.
on our platform because there were so many of you that wanted to come learn about taxes. And so that is awesome. Thanks for being here. Enjoy the rest of your day. And Carly, um, praying for you during tax season.
I need it. Thank you.
Bye, everybody.